this this entire policy framework making sense. So local investors have done a great job. They have not bought into the bullish statements that brokers like us keep churning out periodically. They stayed away. They bought real estate. They put into bank deposits. They have bought gold. And if the markets are like this, I'm pretty sure the currency also will take a hit. So even though the dollar price of gold looks under pressure, I think the rupee price of gold may well be actually fairly stable to compensate for, because of the rupee depreciation. So overall, asset allocation-wise, the locals have done pretty okay. I mean, really can't find fault with that.
How do you position for a market like this, Shankar? The key sectors which have held out have been IT and private banking. And smaller sectors like pharmaceuticals and even consumer. Do you think those will crack as well?
No. Okay, out of the four you mentioned, I think banks overall we are very negative on, extremely bearish, and that is without exception to private or public sector banks. Both have a little bit different reasons, but broadly they fall in the same category. Both are over-owned sectors. We don't like sectors which are over-owned in general. And in case of banking, the earnings expectations are irrational. Going into a very slowing economy, you can't expect banks to stand out and make a lot of money while other sectors are hurting or the consumer is hurting. I mean, it's almost like the tech boom of 2000, wherein we expected all our tech companies to keep posting record earnings, while their end customers, be it the telecom companies and the banking and financial services companies in the US, or even locally Tata Motors, Gujarat Amul Cement, they were all hurting like crazy. But we still expected Infosys and Wipro to keep blowing out the numbers. But they are service providers to these companies, just as banks are service providers to manufacturing and other other areas of the economy. So you can't expect those areas to be hurting while their service provider keeps making hay. So it's the same irrationality, and the most interesting thing is now nearly a third of the Nifty is comprised of by banks. So again, eerily reminiscent of 2000, wherein I think about 50% of the market was accounted for by four stocks, which was the big four ITs, and then you had Z, which was the fifth one in the TMT pack. So we have again manipulated the index in a manner that now you have a disproportionate weighting of financials in the index.